Hello and welcome again to another episode of Rent to Wealth. I am your host, Art. My goal with these is to share with you how we built and scaled our real estate business and how you can do the same. I talk about topics that I have only done. I don't talk about theory. I don't talk about something that sounds good, but I've heard about it. Everything that I'm discussing with you is something that me or my team do in our current business or something we've done in the past. So these videos, I try to keep them condensed to about 10 minutes. So let's get started. Today's video is on how we use credit to boost our real estate business and how you can do it too and never worry about financing a deal again. When you're starting off in real estate, and even sometimes when you're not starting off in real estate, one of the biggest concerns is how to use credit and how to build your business, how to finance your deals. We have a model that we use and it's worked very well. So I want to discuss the different types of ways we can scale our business and how you can do the same thing. So let's get into it. There are three types of credit that we need to discuss for this particular topic. I'm going to talk a little bit about each one, just briefly touching on them here. The first is secured credit. Secured credit is when you have an asset that you own already and you pledge that asset up against the credit. So you have a boat that you own free and clear that's worth $1 million. You tell the bank, give me a loan on this boat. It's secured against the boat. And they might say, okay, well, it's worth $1 million. We'll loan you $700,000. And that is secured credit because it's secured against that asset that is worth more than the credit that they gave you. The second way is unsecured credit. Unsecured credit is essentially when you go get a loan based on your name. So the loan is not secured against your assets. Now, that doesn't mean that they can't take your assets, because when you do an unsecured loan, if you don't pay the loan back, then if you personally signed for the loan, then they can come after your assets to try to collect the money from the unsecured loan. And that's something, like I said, it does not have a backing of an asset behind it. The third is a leverage asset or leverage credit. Leverage credit is when you've got something maybe that you're buying. That's a traditional real estate deal. You're buying $1 million piece of real estate. You're going to put $250,000 down. And that money is then going to allow you to leverage or buy this larger asset, this more expensive asset, leveraging the bank's money to allow you to accomplish your goal without having to actually put up all the money. Now, the type that you use for your business depends drastically or greatly on your goal. One of the other videos I did in the past, I talked about setting your goals, knowing why you're doing this business, and what is your exit plan. Every real estate strategy has its own tweaks and nuances. So if you're a buy and hold investor versus a fix and flip investor versus someone who wholesales property, you need to know exactly what you're going to do with this property and how you're going to get out of this property. That's going to give you the best success, and it's going to make it easier for you to know what kind of financing you need to try to attract and what you need to work on. So know your exit before you even start on this path with financing. So let's talk about secured credit, where it's secured against your assets. This is something like an equity line of credit, where it's equity in your house or something like that. It can also be a stock equity line of credit. If you've got a larger stock portfolio, you can actually go and borrow against that stock portfolio and use that money to buy or put as a down payment on your properties. And you don't have to get rid of your stocks, but they're going to be borrowed against your stocks. And if the issue with that is if your stocks drop below a certain value, then they may call some of the loan due because it's not enough equity available that's covering the loan that you have. So that's another line, secured line that you can use. Typically, secured lines, as I said before, are secured against something you already own, not against something that you're buying, because they're secured against something that you own and you're pulling money out of that asset. This is a great use with quick turn real estate. The reason I say that is because usually with quick turn real estate, you're getting in, doing your rehab if you're doing rehabs, or you're just pricing it correctly and getting out of the property. So it's going to be for a short term, typically for less than a year. Hopefully it's just for a couple of months. And it's a great avenue to use a secure credit for that. It's also fast. If you put it in place before the deal, a lot of times with secured credit, you really just have to write a check off of the credit line that they give you or whatever you have. So it's pretty fast. And you get pretty good terms because for the bank, it's lower risk. So they're not risking a lot. If you don't pay the money, they're going to take the asset that you're pledging against. And so it's a lower risk term. And because it's lower risk to them, you get better financing terms. Now, I will say this. If you're doing quick term real estate, the interest and terms don't matter as much as they would if you're doing a buy and hold. So that's why it makes sense for quick term versus, a buy and hold strategy, because you're going to get rid of the property quickly. So you don't mind putting this money out and then getting it back quickly. Next is unsecured credit. This is the riskiest credit, but it sure sounds good, because I can tell you this. When my bank extended me an unsecured line of $500,000, it sounded great. I thought that, hey, I've made it. The banks trust me. I am their guy. Until I looked at the terms. The terms on that money are horrible. And I'm not going to say they're horrible. They're just expensive. An unsecured line of credit is very expensive. Banks are going to charge you as if they may like you, but that doesn't necessarily mean they don't want to profit from you. To get the best terms, usually you don't even need the money. If a bank is giving you a large unsecured line of credit, it's because they know you're a good risk. You already move money through their bank. They know that, hey, this guy moves money all the time, so we'll probably be able to get our money back, or at least threaten him, and he'll probably pay us back. This strategy, unsecured credit, usually only takes place if you've got good to excellent credit. If you're someone who has low or no credit, or you don't have any money, you're probably not going to have too much luck with getting unsecured credit, because banks typically loan this to people that, like I said, don't really need the money. But it can be used if you have access to this, and you can leverage this. You're going to have to learn to build unsecured credit up. It takes time to get access to large capital. So when I first started with my bank, they initially gave me an unsecured line of $2,500. And we would borrow the money, pay it back, borrow it, pay it back. And then after a while, they said, hey, it looks like you're doing well. Let's up you to $10,000. Same thing. Over time, they said, hey, it looks like you're doing well. Let's up you to $50,000, and so on and so forth. So it takes time to do this. It's not a quick turnaround kind of deal. Now, this is better for experienced investors with good cash flow. The reason I say that is because the banks and the way you're going to have to get this money, they're not going to just give it to you unless you're in a pretty good position. And you need to show that you're experienced. But a lot of times, unsecured credit, they're not even looking for what you're doing with the money. They just want to give you the money. But you can set yourself up by starting small and then building over time. And then eventually this money will be the money you can use for down payments and maybe even to buy a house. Again, this money works best with short-term deals where you're quickly flipping the money and putting it back to work on another investment after you've paid them off. And just so you know, the interest rates, like I said, are typically closer to a credit card rate. And sometimes they could be, I won't say they usually are higher, but they're usually right around credit card rates, 20%, 22%. This video might be dated, so I don't know what the interest rates are, but they're usually 19%, something higher compared to credit cards. Leverage credit. Leverage credit is the most common when buying real estate. Typical financing with a down payment for real estate. This is what you're used to when you go to a bank to buy your home. Hey, we're going to loan you this money. Give us 10% down. We're going to, give you the house, and you'll buy it from there with putting a down payment. These are the best terms for long-term real estate investment. So if you're buying and holding, leverage credit is probably going to be the way you're going to want to go. We use leverage credit all the time, but we typically use it in our commercial deals. We don't buy and hold most single family properties. In my opinion, single family should be for flipping and building cash and capital. Commercial should be for holding and getting a return on your money. But that's just me. But you're going to get the best terms with leverage credit. To scale this, you must set it up before you need it. You do not want to go out and find a real estate deal and then say, okay, let me go get some credit for it. You need to kind of set the wheels in motion before you need it. It'll just help with the stress levels. Woosah, woosah. You want to calm down and get this set up before you get the deal together. You'll be able to find the best deal, and you won't find yourself pinned against a timeline where you got to get the money, so you're more likely to take not so great terms just because you want to get the money. So work on leverage credit, and that'll be something that you can use in the future. Now, I labeled this, how do I find a good lender? But really what you want to look for is favorable terms. The number one thing that I did not put up here in finding a good lender is start looking before you need the lender. That way you can kind of figure out what makes sense. You can ask questions. You want to vet your lender. Your lender is just like anybody else. If I tell you I'm an attorney, that doesn't mean I'm a good attorney. If I tell you I'm a lender, that doesn't mean I'm a good lender. If I tell you I'm a doctor, that doesn't mean I'm a good doctor. So you want to vet them, ask them questions about the loan, ask them questions about the terms, ask them questions about their experience. You want a lender that when the chips are down and the problems start to come up on a deal, which happens all the time, you want to make sure that they're going to work with you and not kind of just look at you like, what are you going to do? You want to actually focus up and make sure that they're, in the trenches with you and trying to help you come up with a solution. Ask your network. If you got a network of other investors, most people that are real estate investors know somebody who's a real estate investor. Ask your investor friends, and they can help you find a lender and give you somebody that you can still vet, but they come from a referral, which is great. Again, you got to know your exit with the lender. You got to know that this lender is going to, you got to know what you're going to do to get out of this deal so that when you talk to them, you can say, hey, this is what I'm going to do once I get the money. It'll make the whole conversation much easier. Now, if you're interested in this, because I don't want to just have you say, oh, this is great, but I didn't actually get any financing. We have a commercial line of credit with the bank. We have a commercial bank that we actually have a commercial line of credit on. We have a couple of $1 million on that line of credit that we can use to buy single family properties. Now, the way these lines of credit work, if you're interested, I'm more than willing to share this contact with you. If you're interested, the way it works, you got to put down a down payment. Usually it's about 10%. And then they're going to finance the rest, but they're not a hard money lender. And the great thing about them is that they pay for the appraisal. They pay for everything up front. So I don't pay anything up front once I get started with them. And you get pre-approved and qualified first. And then once you're pre-approved and qualified, every time you find a deal, you simply go to them and say, hey, here's a one-page sheet that explains the deal, what you're doing with it. And then they'll turn around and give you financing and start the whole process. And it's very easy. If you like, follow the videos, follow my page, make a comment, or, hit me up in the messages. I think I have my email. I put my email in the comments so that you can send me an email, and I'll kind of just ask you some questions to make sure you qualify with this lender. And if so, then I'll be happy to share the contact with you. No charge, no nothing. I don't benefit. I'm not the lender. So it'll be something that you can share with. You do need to have some credit and some cash with this particular lender that I'm talking about. You don't need to have a ton of cash, but you need to have some money because they're going to want to see that you can put money down on a property. But if you actually, and one last thing, this is for serious investors who have some experience. If you've never done a real estate deal and you're just getting started, you're not ready for this, and you might want to watch some of the other videos that I have about how to do no money down, no credit financing. But this is for more of an experienced investor. Now, as I'm talking about this, I want to make sure to share this information that you can use combining these financing techniques to actually do 100% zero financing, zero down payment deals. So you can use secured lines of credit with your leverage line of credit to use the secured money to put the down payment down. And then as long as you bought the property right, then you can turn around and get the money, pull the money back out of the leverage deal to pay off the secured deal. Now, let me explain how that works. Let's say we're buying a house for $100,000. And so the bank says, okay, great. Now this house is worth $150 as it stands right now. Fixed up, it's worth $200,000. So it's worth $150 now. We're buying it for $100, and it's worth $200 once you fix it up. So what we're going to do is we're going to go to the bank and say we want to borrow $100,000. They're going to say, okay, well, we can't loan you the whole $100,000. We're going to loan you $90,000, which is 90% of it, and you put 10% down. I'm going to then go to my line of credit. Oh, before that, I'm going to tell them, it's going to take about $20,000 to fix up the place. So they're going to say, okay, we're going to loan you basically as long as the place fixed up they loan up to 75% of the fixed up value. So you're going to be able to borrow, I don't know what the numbers come out to, 200,000. So you're going to be able to borrow 150, something around 150. You're not going to borrow 150 though. You're going to borrow 130, but you're going to put 10% down. So what's going to happen is you're going to put the $10,000 down. They're going to give you $90,000 at the closing, and then you're going to have $30,000 sitting up in escrow. And as soon as you make the repairs or whatever it needs to be done on the house, you're going to get that money back. So you're going to use your secured line to put the down payment down, and you're going to use your secured line to pay for the repairs. So you spent $30,000 on the repairs and the down payment. $20,000 on the repairs, $10,000 on the down payment. I'm then going to go to the bank and say, hey, I fixed up the house. It's now worth $200,000. They're going to say, okay, great. They'll send someone out, verify that you fixed it up. They're going to give you $30,000. Didn't change the loan terms. The loan terms are exactly the same. You borrowed a total of $120 because you got $10,000 down. You borrowed $20,000 more for the fix up. And so you borrowed $120. They're going to give you that $30,000. You're going to take that $30,000, pay back your secured line. So now your secured line is paid off and your repairs and property are paid off. Now you can sell the property or refinance it for $200,000 or close to the $200,000. If you're rehabbing it and selling it, you'll sell it for the $200,000 or close to it. If you're buying and holding, you're going to refinance it, let's say for 85 cents on the dollar. So let's say they'll refinance it for $175. And then you're going to pay off the old loan, and then you'll have a new loan at $175 on a $200,000 house. So that is a very quick explanation of how to use two of the types of financing to get 100% financing. Using secured and leveraged, or even unsecured and leveraged, or secured and unsecured. You can do the same thing with secured money and unsecured money, but it has to be quick turn for that to work. You can use any of these, and that'll let you get coming out of or keeping your cash out. You can basically work on the bank's money. You want to be creative with these plans, but you also want to plan out the steps and worst case scenarios, because you do not want to over leverage yourself. You don't want to borrow more than you need to just for the sake of borrowing. You want to make sure that the numbers still make sense, and you want to have a worst case scenario. If the property were to drop in value, that $200,000 property were to drop in value, let's say it's only worth $175. Well, remember, I only owe $120 on the place, so I'm still protected because I purchased right. So that protects me, and you want to look at worst case scenarios. Now, once you find a way that works for you, a system like one of these that works for you, you want to rinse and repeat and keep doing it, and you'll be more than happy with the results, and you'll build your unsecured lines. You'll build your leverage. You'll get a larger leverage line as you can do more deals, and you will make a fortune. That's the best way I can put it. So I am way over my time. I'm close to 17, 18 minutes. So I want to stop here. If you have questions, I'd be happy to answer them. Leave a comment in the comment section. If you want access to that lender that I'm talking about and think that you might qualify, then hit me up on an email. I put my email in the comments, and I'd be happy to share, and hopefully you'll be happy investing. So until next time, I wish you the best. This is Art with Rent to Wealth. Hit that like and subscribe button. Like these videos. Let me know that someone's watching and I'm not just talking to myself. And I look to see you next time. Thanks.